Today, all about the mortgage and property market. Hello again, it's Martin North from Digital Finance Analytics. Welcome to today's post covering finance and property news with a distinctively Australian flavour. Well, at the end of the month, we once again have got the latest data from both APRA and the RBA relating to mortgage trends, and it's worth looking at those in some detail. And we're also going to cover the up-to-date information from the Productivity Commission, who basically threw cold water all over the idea of first home buyer grants. And we'll look at Queensland and their reversal on the property tax issue. And finally, we will also look at the latest from the ABS relating to the wealth destruction, which is currently underway and which I suspect is going to accelerate ahead. Now, whether it's real wealth or just paper wealth is, of course, a moot point. Anyway, let's start with the APRA data. So the monthly authorised deposit-taking institution statistics up till the end of August were released today as normal. And it's quite interesting. Remember, this gives you the balances outstanding at all of the major lending institutions, the authorised deposit-taking institutions, they're called. So the first place to start is to look at the change. So over the month, the total pool of mortgages grew by 0.51% for owner-occupied mortgages. For investment mortgages, it grew at 0.33%, and the total was 0.45%. And you can see that that's considerably down from where we were a few months ago, just slightly higher compared with last month. So it does confirm the trend that we've seen, that the rate of growth is easing back for mortgages. No surprise given the higher interest rates. Now, the total outstanding pool of mortgages across all of the financial institutions is just over $2.024 trillion. That's another record. So we keep hitting new highs. And if we look at that in more detail, we can see that both the owner-occupied lending and the investment lending continue to grow, although actually, relatively speaking, the investment lending as the proportion of total pools of mortgages outstanding continues to slide. It's now down to 1/3, 33.02%. But I would remind you that that's still very high. Remember that the Bank of England was worrying when 16% of all mortgages were for investment purposes. Well, we're still at double that in Australia. So we still have a very large investment pool. And there are considerable risks attached to that, I think. Then we look at the selected portfolio movements over the last month. And we can immediately see that the majors like Westpac and Commonwealth and National Australia Bank are ruling the roost when it comes to growth in the portfolios. But I would highlight the fact that Macquarie Bank continues to drive investment lending harder than anybody else. And interestingly, we notice that ING and HSBC and the Bank of Queensland are losing relative share. Now, of course, there are different strategies being executed by individual lenders, and this just gives you a little bit of a snapshot. And sometimes the figures are distorted because they might be clearing balances out into, for example, securitized pools. But nevertheless, it does give you a fairly good view. And you can see that a lot of the focus is in the owner-occupied sector of the market. And at the moment, we think that investment lending is easing back even more quickly. And with that in mind, let's look at the RBA data for August. So they said that the year ended August 2022, the total credit grew by 9.3%, compared with 4.7% the previous year. Within that, housing grew at 7.6%, compared with 6.2% last year. Personal lending still dropped slightly, but only down 0.6%, compared with down 5.6% last year. And business credit is booming at 14.1%, compared with 3.4%. Now, it must be said a lot of that business lending is because of cash flow issues. Businesses have to borrow to deal with extended credit terms and those sorts of things. The level of investment is still relatively low. And then the broad money is at 9.1 compared with 7.2 a year ago. Now looking at the most recent monthly movements, well, total credit grew by 0.8% again. Housing credit was 0.5% again. Personal was 0.3% again. And business was just down slightly from the prior month. Now, if we then look at the monthly trends, housing credit grew by 0.52% over the month. Owner-occupied loans were at 0.56%, and investment loans were 0.46%. And you can see there that there has been definitely an easing back compared with March and June last year. And if you look at the details later, as we'll show, the rate of decline is actually increasing slightly. Personal credit grew slightly, 0.29%, having been somewhat negative in recent times. And that's one of the factors to bear in mind, that are more households now reaching for additional credit because of cash flow problems. The overall business growth was 1.22% in the month, which is down from where it was the last couple of months. Now, these monthly movements are, of course, very noisy, but it does show you that old credit grew at 0.79%, which is a little down from where it was previously, but still not too bad. If you look at it in terms of more credit is better, that's debatable, I think. Broad money is at 0.3% in the last month and is falling away, and that's part of the tightening process that the Reserve Bank is, I think, involved in. If we look at the annual movements, which gives you perhaps a longer term view, housing credit overall grew by 7.56% over the last 12 months. And you can see that that has definitely come off from a peak in the December and March quarters. Within that, owner-occupied loans were at 8.04%, but well down from where they were a few months ago. And investment lending is now also beginning to ease a little, although it lagged the decline in owner-occupied loans by a few months. Looking at personal credit, it's down 0.55% over the year, but you can see that it's beginning to move towards positive territory. I do expect it to move into positive territory as more households reach for more credit to try and get by, given higher interest rates and also the pressure on other costs of living. Business is 14.1% higher than a year ago, and that, of course, is where a lot of the growth has been. But the really interesting question is how much of that is purely working capital because extended credit terms have been on offer, and how much is real investment. It's hard to tell, but from my surveys amongst small business communities, a lot of it is purely working capital and having to settle tax bills. If we look at the aggregate growth for the year, you can see that all credit grew 9.35% over the year, so that's still pretty strong. And broad money is at 9.08%, so it's still higher than it was a year ago, and it's interesting that the broad money and all credit numbers are now pretty close. And we will just look at the 3-month RBA credit aggregate because the 3 months gives us slightly more focus on recent events. And we can see that housing is 1.63%. Within that, owner occupation is at 1.68%. And investment lending is 1.53%. And you can see quite clearly there that all three are trending down now. Personal credit was 0.26% and is moving up. And business credit at 4.06% is actually moving down last month. And if we look at the overall credit aggregates, 2.42%, moving down slightly. And broad money is 1.69% and also dropping. Now, here is the information from the ABS relating to the household assets across Australia. And the first observation is that the currency and deposits that households hold continue to grow. That's been quite a strong trend in recent times, as you can see there. And you can also see that the shares and other equity is also relatively solid. But if you look at superannuation balances, they are reducing. That's, of course, because of the down market movements. On the other hand, if you look at credit and loans, they're rising, and that's consistent with the earlier information that I showed. But the real kicker here is the residential land and dwellings values, which have dropped quite considerably. And I would remind you, this is to June 2022, so you should expect it to continue to fall over the next little while, as prices have already dropped further. And talking about this wealth destruction, whether it's real wealth or paper wealth is a debatable point, of course, but the ABS certainly revealed that the total housing wealth declined by about $484 million over the quarter, and that was driven by a $280 million decline in the value of financial assets and a $156 million fall in the value of housing assets. Now, on a per capita basis, and of course that averages out and it's not necessarily very helpful, household net wealth fell by around $21,500 over the quarter, driven by a $12,100 decline in the value of financial assets and a $7,900 decline in the value of housing assets. But of course, the situation has deteriorated markedly since the end of June because of the continued aggressive rate hikes. 5-day city aggregate dwelling values have fallen a further 3.6%, which would have roughly equated to about $344 billion of Aussie household wealth based on the ABS's figures. Now, here's another interesting thing that's happened today. Queensland has scrapped the controversial Queensland land tax change, and the Premier stepped in to scrap it. Of course, there were a lot of damaging discussions in recent weeks, and they made the decision after discussions with the other state premiers. Of course, the New South Wales Premier had rubbished it quite recently. The idea was that anybody holding investment properties in other states would be taxed at a higher rate in Queensland, but that required sharing information across the states, which potentially could be quite awkward. And the overall amount of value that was going to be created by bringing it in was also relatively low. So no real surprise. The only surprise was that this was brought in the first place. Finally, the Productivity Commission published a significant report today all about housing, and there were a very significant number of points in this report, but I want to highlight specifically this observation. They basically said that supporting first home buyers through home buyer grants was actually not a useful exercise. Why? Because it pumped up prices and didn't actually support those people facing homelessness. So their recommendation is that these should be redirected to help those facing homelessness. So the Productivity Commission suggested that governments should phase out financial assistance for first home buyers and redirect that support for those on the brink of homelessness. And we'll probably come back and go into the report in more detail, because it is worth noting that there was about $3 billion of support made through various home buyer schemes in recent times. $3 billion is a big number, and that, of course, just pumped up property prices even more and made it less likely that people could actually get into the market at all. So, of course, the real question here is whether, in fact, anything will change. The government still seems wedded to its strategies relating to home building and support for home purchases. But the bottom line is, and it's continued to be the case, that really first home buyer grants are just supporting the construction industry, not individuals. And it's actually putting more upward pressure on home prices at a time when we should be looking to put pressure down on home prices, not least because of the higher interest rates that are coming through the system now. So that's a quick update. I hope that was useful. The key point to make here is that credit is definitely coming off. Momentum is easing, and the total value of assets that households hold are actually reducing. And if you think about it, that translates into potentially household spending less ahead. One reason why consumer confidence is still pretty weak. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.